All right, I want to welcome everybody to the September HR Roundtable. Of course, for me, a third time was not the charm. I was having technical issues on my end, and some staff helped us out here, but I think we've got it all together now. I want to welcome you all to HR Roundtable, and we want to, our monthly sponsor of these events, if you've been in any of them before, is Qualified Plan Advisors. And actually we have Jasen with us today that is a speaker. So I will go ahead and turn it over to him. We have Jasen Mangrum with he's a financial planner with Qualified Plan Advisors. And then Lisa Wolff, who's a Senior Vice President and Director of Premier and Private Client Services at Midwest, and they will both be presenting on employees' financial health. If you have any questions, you can throw them in the chat, or we will also have some time at the end if you want to unmute yourself and do it that way as well. We will go ahead and get started. I'll throw it over to Jasen.
All right. Well, thank you very much, Shannon. So I'm actually filling in for Mark Gash and Matt Brown. They normally attend these meetings, but they're both tied up today. So just wanted to take a couple of minutes. Qualified Plan Advisors is one of the premier 401k advisory shops here in the city. We actually handle about 500 plans for companies across the country. And so we always try to pick a topic to discuss that ties into with today's featured speaker. And so financial wellness is a big term in our industry, making sure that employees are on track for retirement, obviously so they can have a nice, long, stress-free retirement, but then also to where they're not a potential stress or a strain on the company's bottom line as far as like health costs are concerned, extra sick time, lack of productivity. We just, you want your employees to be at work because they want to be there, not because they have to be there. So from a 401k standpoint, what kind of sets us apart from our competitors here in town and across the country is we actually enroll face-to-face one-on-one meetings with all the participants in our plans, whether that is me sitting down with them with my laptop and going through everything and answering any of their questions, or doing a virtual meeting like this, which is a lot more popular nowadays. Your screen there, I actually gave Lisa a couple of slides to share before she starts her presentation, but as a result of those one-on-one meetings and that constant interaction, rather than just like throwing a book at an employee that's like 50 pages long and say, here you go, figure it out on your own. This is this is a client of ours in the healthcare industry. And we have a lot of our plans audited as far as, where they were and then what they are, where they're at after we implement our services for those companies. So this is like I said, this is a healthcare provider. And Lisa, if you scroll to the second page there, you can actually see just by implementing those one-on-one face-to-face meetings, just that employee engagement. Uh-oh. Hello?
We can hear you, Jasen.
You can hear me. All right. Well, I can't see anything. So that's awesome. So let's just go ahead and wing it. But hopefully you can see the second slide there. I don't know the numbers right off the top of my head. So, but you can see where participation rates for the company, they went up. Average deferral rates, meaning the percent of the paycheck that's coming out of each employee's paycheck and going into their retirement account, that dramatically increased as well. And it just gets them on track for a better retirement. And then the third thing is you can see the average number of investment options also. I believe they went up like 300%. They practically tripled roughly, just meaning they're more diversified rather than just kind of throwing a dart and picking one fund type of thing. So that's just an example of the services that we provide. The second thing that I sent over to Lisa is when it comes to talking to companies in a group setting, we actually age band our group education, meaning that, you know, college savings and saving for your kids' college might be important to somebody in their 20s and 30s that has small children. But for those folks that are, say, in their 60s, that's really not a real focal point for them. So whatever education that we provide to our clients, we actually age band them to make it pertinent. You know, we're not going to talk to younger employees about Social Security options when, you know, when they're nearing retirement, because it's really not important. So that's another thing that Qualified Plan Advisors does, as far as just the group education, is just tailoring it to their employees' needs, whether it's, you know, those age-banded things, or we'll talk to a HR director and just ask them, hey, what's the talk around the water cooler? What do you think are some good topics to talk about? So that other attachment that Lisa has there just kind of goes over some of those topics that we can talk to your employees about. So that's about it. And hopefully everybody can still hear me.
Yes, we
Jasen,
can.
it's Lisa, I can hear you. Okay.
Perfect. Thank you,
Awesome.
Jasen. We will turn
No
it over
problem.
to Lisa.
Okay. Good afternoon, everyone. First and foremost, I want to thank the Olathe Chamber for having me on as a guest speaker today to talk about one of my most favorite topics, health savings accounts. I think this is an account, a program that falls very well in line with talking about your employees' financial health, especially when it comes to their health care options now as well into the future. Just a little bit about me. I work for MBH Bank, which is our umbrella company. We have brands in the Kansas City area, Bank Midwest, as you know. Specific to the Olathe area, we have banking centers on Santa Fe and also on 119th. I believe some of you are actually some clients, so thank you for that. But we also have brands in Colorado, Texas, New Mexico, and Salt Lake City. So I represent and support those brands as well. So Premier and Private Client Services is what I do. I also wear another hat, and it's the reason why I'm in front of you today, as I am a certified health savings professional. So part of what I do is exactly what I'm doing here today, is partnering up with people to discuss HSAs for company owners, employees, how we can help them additionally benefit their employees with this great account. So let's get started. For those of you that are new to a health savings account or have never experienced a health savings account, either as an employee or as a business owner, that HSA is a tax-advantaged account that can be used to pay for your qualified medical expenses now or to save for future expenses later in life. It's for you, the funds are for you, the HSA owner, your spouse, and your dependents, okay? And just a brief history on HSAs, the IRS brought this account to us in 2004. It was exactly what it is today for us back then, as a shift into CDHC and healthcare, that stands for Consumer-Directed Healthcare, promoted those new high deductible health plans, high deductible being the key word there. So what the IRS did is they said, well, you've got these higher deductibles that you have to pay out of pocket for your healthcare expense. We're going to assist you or help you with that by creating an account that's a tax-advantaged account that you can put money into to help pay those deductible amounts. So that's exactly what the account was designed for in 2004. That's what the account is used for today. However, today, really starting in 2013, 2014, the other shift on the account, and we'll look at how fast this account is growing nationally. The next thing in that account is the savings opportunity. It's not an FSA where you have to use your funds in the FSA before the calendar year is up or you lose them. It's the exact opposite of that, where you can roll your funds over and save for future expenses later on down the road or well into retirement age. We actually term this account the medical IRA. Okay, so we'll take a little bit deeper look into that in just a moment. The national HSA asset growth, I think this is important to show because it really drives home just how popular this account is becoming. In 2019, we ended with almost $66 billion in assets held in 28 million accounts nationally. That's a 23% increase in assets and a 13% increase in accounts. Account holders, HSA owners contributions were up 14% in 2019, and they grossed $38 billion. And health plan partnerships and employer relationships accounted for almost 69% of new accounts in 2019. What that last bullet means is that employers are looking to also contribute to their employees' HSAs to additionally benefit and perk their employees, but also there's a tax advantage for the employers to do that, and we'll look at that in just a minute. Real quickly, at the end of this year, coming very quickly for all of us, we're estimating $77.4 billion in assets. So again, pretty phenomenal growth in this account. And then at the end of 2021, $90.3 billion in assets. Just went over that. Okay, industry contributions and withdrawals. In 2019 activity, we saw $38.5 billion in contributions. We saw $29 billion in withdrawals, which means that we retained in these accounts, meaning people are saving their funds in their HSAs year over year. In 2019, we saw retained funds of $19.5 billion. Okay. That's 42% of accounts contributed more than they withdrew in 2019. So we are seeing a trend, and we believe it's going to continue this year when we look at the data, and 2021 as well, upward trend that people are saving their HSA dollars more than they are using those accounts down to zero year over year. In 2019, we saw 27% of all HSA dollars contributed to an account came from an employer. So those are your employer contributions. And we saw 60% of all HSA dollars contributed to an account came from an employee. So you've got the employer contributing and then the employee contributing as well to max out that HSA. And then 12% of contributions were individuals that weren't linked or associated with an employer. So those self-employed or anyone really that has a high deductible health plan that makes them eligible for an HSA, they're also contributing to 12% of the contributions. So just real quickly, let's look at the HSA. The advantages of a health savings account, typically there's a cost savings. When you look at a PPO plan versus a high deductible health plan, typically your premium dollars paid for that plan, for that coverage, are less in a plan year for the high deductible health plan versus the PPO. So there's a cost savings there in your premium dollars. And that's not just for your employee, that's for employers as well. Tax advantage, we'll look at that a little deeper, but this is the only account out there that is a triple tax advantage, okay? It covers a wide range of expenses. It's not just your doctor visits. It's not just your prescriptions. It can cover dental. The funds can be used for dental. They can be used for vision, for chiropractic care. It's a wide range of availability to be able to use your HSA funds towards your out-of-pocket medical expenses. It's flexible. You get to choose how you use those funds. You can choose to save your funds and roll them over year, or you can choose to use your HSA dollars all the way down to zero for that year. It's complete, or do any combination of the two. It's completely yours to control, your account in its entirety. And then there's no use it or lose it. I mentioned the FSA. The FSA is the account, the flexible spending account, that you contribute pre-tax to the account. However, you have to use all of those funds in the account by the end of the calendar year, or you forfeit those funds. This is the exact opposite. The HSA is the account where if you don't use your funds within that year, they roll over for you to use in the next year or years on beyond that. And then it's portable. It's not linked to your employer. It's individually, completely owned by you. So say that you have an employee that leaves, they take that account goes with them. They control what happens to the account. The employer has nothing to do with it. So this is something I always like to add into the presentations. I think it hits home, and that why would you buy retail when you can buy wholesale? That's essentially what having an HSA and using those HSA funds is about. Why would you go to Price Chopper to buy paper towels in bulk when you can go to Costco or Sam's and buy the same amount of paper towels in bulk at a wholesale price versus a retail? So paying out of pocket versus paying pre-tax. Every dollar you contribute to your health savings account equals a full dollar spent on your medical expenses. More pre-tax contributions equals less payroll taxes. Every dollar that you are pre-tax contributing to your HSA, to your 401k, equals less payroll tax for you, the employee, as well as your employer. And then here's that triple tax advantage on the account. Contributions to your HSA are tax deductible, and if made through payroll are pre-tax. Interest earned is tax-free, and distributions for qualified medical expenses are tax-free. That's different from your IRA or your 401k. Once you start distributing for either one of those accounts, you are taxed. It's considered income. That is not true on the HSA. Anytime that you distribute for qualified medical expenses, it's tax-free. So there's the triple tax advantage on the account. HSA eligibility, you've heard me mention a couple times a high deductible health plan. This is the health plan that you have to have in order to be eligible, in order for your employees to be eligible to have an HSA. They have to be covered by a high deductible health plan. They generally cannot be covered by a non-high deductible health plan, so no other secondary insurance. They cannot be enrolled in Medicare, and they are not eligible if they're claimed as a dependent on someone else's tax return. Okay? That's what the IRS is telling us you have to have in order to be eligible to have an HSA. So those high deductible health plan requirements, the minimum annual deductible for self-only coverage going into, well, we'll look at 2021 because, man, we're almost there, is $1,400 for family coverage. That deductible needs to be a minimum of $2,800. And then the annual out-of-pocket for 2021 is $7,000 for self and $14,000 for family. Okay, so those higher deductible health plans, the deductibles are they're higher than traditional insurance plans, but with lower monthly premiums. You pay more for your health care costs before the insurance starts to pay, but because the high deductible health plans are often combined with HSAs, you can pay those upfront costs, those deductibles, with money that hasn't been taxed. Okay? So here's where we get to the fun stuff. Your annual contribution limits. This is what you can contribute to your HSA per calendar year. Okay? So in 2021, let's go over 2020 because we're still there. And just like with your IRA, you do have up until tax day, April 15th, to contribute to an HSA for 2020. So you have until April 15th, 2021. So those contribution limits for self-only coverage is $3,550. For family is $7,100. And then you'll see in 2021, we actually just got the numbers here recently. The IRS has bumped those max contribution limits again, $3,600 for self, $7,200 for family coverage. And then if you are age 55 and older, you get a $1,000 catch-up contribution from the time you turn 55 and every year thereafter. Okay. And let me point out one other thing on contributions. That is aggregate contribution. So if your employer is contributing to it and then the employee is also contributing to it, you need to add those two together and make sure that you're not going over your max contribution limit. Qualified medical expenses. Everything that you need to know about whether it's qualified or not is in IRS Publication 502. Makes some great bedtime reading, as any IRS publication does. But keep in mind, just a few things to keep in mind with medical expenses. Your preventative care, just like with a PPO plan, with a high deductible health plan, all of your preventative care is zero out of pocket, okay? So your well woman checks, your well child checks, all of those things that are considered preventative care, mammograms, all of that are at zero out of pocket. So you're not paying deductibles for those. All the rest of the medical expenses that can be used. Let me back up. I just got tongue-tied. All the other qualified medical expenses that you can use your HSA funds for are listed in IRS Publication 502. Recent COVID-19 developments, I do believe this still holds true, as they are treating any testing or treatment as preventative care, but I do want you to go and check with your healthcare provider on that, because we're in times where things are changing daily. With what rules or regulations that they're putting out. Always keep your receipts just in case something were questionable or the IRS were to come calling. Always keep your receipts or your HSA statements. And then just a reminder that HSA funds cannot be used to pay your health care premiums unless it is COBRA or unemployment-related coverage and certain long-term care coverage. The other thing I will add to that, but we'll look at it a little bit deeper in just a few minutes, is that once you turn age 65, you opt in on Medicare, you can now use your HSA funds to pay for your Medicare premiums. Just a reminder that non-qualified distributions prior to age 65, because we're going to look at how much better this account gets for you at age 65. But non-qualified expenses, if you distribute for anything that's not qualified as a medical expense by the IRS, it does become taxable, and then you are possibly receiving a 20% penalty in tax unless it's an exception, okay? So let's take a little bit deeper dive into the benefits to you, the employer, and to your employees. Can you actually save money on your health care? Well, the Bureau of Labor Statistics states that health care is the second highest cost for employers. Rise in premiums equals a rise in claims. 6% of your employees represent 47% of total allowed medical and pharmacy spending. And so how do you manage to this? Well, we believe it's consumer-directed healthcare. And again, consumer-directed healthcare, CDHC, basically means that high-deductible health plan coupled with the HSA, okay? And then also to motivate your employees through wellness screenings and HSA contributions. So high-deductible health plans and HSAs go together. You cannot have an HSA without a high-deductible health plan, or at least you can only contribute to an HSA while you're a participant in an eligible plan. You can have a high-deductible health plan without an HSA, but that means you're missing out on the full benefits of the high-deductible health plan. Studies show that when an employee is responsible for their medical costs, they will choose more wisely how and when to spend those dollars. Okay, so that is, in a nutshell, consumer-directed health care. You're incenting your employees to do their homework, to think twice about what they spend in health care through having a high-deductible health plan and an HSA, because they're in control of their decisions with that and what they're paying for. So benefits to the employer, here's that tax savings, always the biggest benefit. Lower payroll taxes. Neither you or your employee are required to pay payroll taxes on HSA contributions that you make into your employee's HSA and for the amounts they elect to contribute through payroll deduction. Okay, so it's lowering your payroll tax as an employer. It's also lowering the employee's payroll tax. And then the federal tax deduction for employer contributions made toward employees' HSAs. So whatever dollar amount you decide you're going to contribute on an annual basis to your employees' HSAs, you receive a federal tax deduction for that. Lower health care costs, lower insurance premiums. With a high deductible health plan and an HSA, you can save on health insurance premiums without sacrificing quality coverage. Lower annual premium increases. As employees take ownership over their health, it will result in lower increases in premiums for you, the employer, and more responsibility put on employees to manage their health care costs, which lessens your administration costs. Oh, missed a heading here. And then the other benefit to you, of course, is employee retention and satisfaction. We all know that turnover is expensive. Onboarding new employees is expensive. We as business owners want to hire great employees and retain them, not lose them to our competitors. So what's the cost of hiring versus the cost of keeping an employee? Exponentially higher. So having that high deductible health plan with an HSA, we in the industry argue that it improves employee recruitment and retention because a lack of benefits is a major reason why employees leave jobs. High deductible health plans and HSAs can help employees save money and invest in their future, and it increases employee satisfaction. You are empowering your employees. That's the key to employee financial health, empowering them to save on taxes, to give them more buying power when it comes to medical care, and it also gives them an option to save for retirement. We'll look at that in just a minute. So it does make a compelling case that your employees will stay with you a long time. Oh, I had a double slide, that's why. And then benefits to the employees. HSAs are the best medical savings vehicle on the market. Because of that triple tax advantage, very true. Lowers monthly premiums. Those high deductible health plans can save employees hundreds of dollars each month in lower premiums. Tax-free savings for retirement health care costs. They have the option to invest their funds and let them grow long-term to cover medical expenses in retirement. And they have the ability to roll over funds and change contribution levels. So HSAs don't have the use it or lose it limits. So your employees' financial health. How can HSAs help your employees take control? They encourage your employees to take control of their finances by providing a savings vehicle for increasing medical costs. Triple tax advantage. There's no other vehicle out there with a triple tax advantage. They spend less on premiums, therefore contributing more to their HSA. They pay out of pocket now, grow their HSA funds tax-free, and reimburse themselves tax-free. That's called the reimbursement feature of the account. We'll look at that in depth in just a minute. HSAs encourage employees to take control of their health, consumer-driven healthcare mindset. Okay, they're taking control of their decision-making. They take a more active role in their healthcare decisions by researching the best and lowest cost care options and prescriptions. And coupled with proper education and engagement, ultimately your employees can save dollars. HSAs encourage employees to take control of their retirement. Funds carried over year after year, HSAs can be a part of a retirement strategy. So here's where I mentioned HSAs as that new medical IRA. If we look at covering healthcare costs in retirement, and this data might be a bit old, I need to go out there and look. I'm obviously nervous too because I have a feeling these numbers will have increased. But this was data given to us back in January 2017. They're saying a man by the age of 65 will need $127,000 to address his health care expenses in retirement. $143,000 will be needed by a woman by age 65. $349,000 needed by a couple for health care in retirement. So not fun numbers, but realistic when you look at our pending retirement years and what we're going to need in order to address our health care expenses. Okay, and I don't want Jason to get mad at me on this, so I'm going to put a disclaimer on this. This is in no way to say that you should invest in your HSA before your 401k at all. Your 401k is equally, if not more, because you can contribute more annually, of course, to it, as important as an HSA. It's just, this is an example to show you just the power of that triple tax advantage when you compare the HSA to the 401k, okay? So just a real quick example, Gina, age 40, owns an HSA. Tommy, same age, 40, owns a 401k. Gina accumulates $100,000 in her HSA. Tommy accumulates same amount, $100,000 in his 401k. With the HSA funds, that account offers immediate accessibility. You can use the funds anytime. They may be invested just like a 401k and are non-taxable distributions if used for qualified medical expenses. The perks or the features of the 401k funds, they can't be accessed without a triggering event, and they are taxable when distributed, okay? So Gina's spending power for qualified medical expenses during retirement is over $1 million versus Tommy's spending power during retirement after paying taxes on the 401k of $780,000. So there's the power of that triple tax advantage. Okay. So HSAs is a type of retirement account. Let's take a look at the triple tax advantage and the reimbursement features on an HSA. We'll call this couple Tom and Jane. So Tom and Jane contribute maximum, so they max out their HSA each year with pre-tax contributions. They add every year to the account each year, and they watch it grow. They choose to pay out of pocket, so they're not using those HSA funds that they've contributed each year to pay their out-of-pocket, to pay their medical expenses. They're choosing to pay that out of pocket each year that they're saving in their HSA, and they save and track their medical bills for each of those years. let's call that 10-year term. You can do this for decades and never draw on your HSA balance. You can let your HSA grow like a retirement account, and at retirement, you may kick in the reimbursement feature. You can withdraw at any schedule you would like to total past medical bills over previous years. So let's say Tom and Jane spend $2,500 a year in medical expenses out of pocket. That's $50,000 in tax-free withdrawals to use for whatever they like. So let's talk about that reimbursement feature just a little bit more if you're unfamiliar with it. I think the easiest way to do it is to give you another example. Let's say I, Lisa Wolff, choose in year 2020 to max out my HSA, and any medical expenses that I take on, I pay out of my regular checking account because my intention is I'm going to save for future medical expenses down the road. Let's say I get 2 years down the road and I come into a position where I'm cash short, or I need some cash for, I don't know, I have college age kids, so who knows, a new laptop. And let's say I need $2,500 in a couple years. I can go back and reimburse myself for all of the medical expense that I paid out of pocket from my HSA fund. I can just simply transfer those funds over tax-free because I paid out of pocket for those medical expenses. Okay, that is the reimbursement feature, which makes that account even more flexible on how you use it. It's a really nice feature to the account. You just have to do a really good job of saving your receipts and proving that you're reimbursing yourself the amount or less than the amount of what you paid out of pocket. And then this account gets even better once we turn age 65. You continue to use your HSA to pay for medical care. You just cannot continue contributions if you opt into Medicare coverage. So this is where it gets a little different. If you opt in on Medicare, you still have your HSA. The funds are there for you to use. You can even now pay, if you look at bullet item number 2, you can now even pay your Medicare premiums with your HSA funds. You can just no longer contribute to the account if you've opted in on Medicare, okay? And you can now use your HSA as a retirement account. You take distributions for anything you want without penalty. It is treated as taxable income. So let's make sure we understand. Once you turn age 65, if you decide that you want to use your HSA funds to go buy a boat, a fishing boat, you can do that and you won't be penalized. It will just be considered taxable income, just like you just distribute from your 401k or from your IRA. Okay, another nice perk to the account. And then recent news on HSAs, Health Savings for Seniors Act is out there, which would allow Medicare beneficiaries to contribute money to their HSAs. Basically, that's legislation out there looking to be passed that would allow you to continue to contribute, if you are able to your health savings account, even if you've opted in on Medicare, okay? And then the Personalized Care Act, PCA of 2020, redefines eligible individuals for HSAs to allow increased participation. So basically, this is a legislation out there that is saying, hey, let's make this HSA available to everyone, regardless of what type of health insurance coverage that you have. That's something that I'm super excited about. And then the Act also is looking to increase the limit on contributions to HSAs. It's allowing to permit the payment of health insurance premiums and lower 20% penalty on non-qualified distributions from HSAs to 10%. So there is legislation out there looking to make this account even better for us. That's how much they believe in it to help us in our ability to save for retirement in today's economy. So as employers, as company owners, what should you look for in an HSA partner? Education, communication, client service, low fees, and online tools, okay? And then we as your partner here at Banquet Midwest, we do all of those things for you. We work directly with the HR director to build a communication plan and an education plan for your employees. We do your new account establishment. We have employer contribution and support options through our business banking portal, employee education provided by certified HSA professionals, easy payroll contribution processing, the Visa debit card for all HSAs, banking center and call center support, and online tools to empower your employees. The one last little plug that I'll say about our health savings account, because I think it's really super special, is that we pay 1.59% currently on our HSA, 1.59% interest. It's never been lower than that. It's been all the way up at 2%. That is well above anyone else in the market, especially those national providers out there paying 0.2, 0.3% on their HSAs. So that is, that's a really nice way to say, hey, Mr. and Mrs. Employee, I appreciate you and want to additionally perk you by offering you this great HSA account. And that wraps my presentation. That is my information right there. If anyone needs to get to me directly, please do. But at this point, Shannon, I can open it up for any questions for either Jasen or I.
Sure. I was going to go ahead and open it. I actually have a personal question because our office is looking at, we are currently on a PPO plan, but we're looking at an HSA plan. My question is, my husband is already on one with my daughters. Can I have my own account separately through my employer?
Yes.
Okay.
So are you going to opt in on your employer's?
Yes, I would stay on my employer. I'm on it now and I would stay on it.
Okay, yep, you absolutely can.
Okay.
And he would keep, so if he's got himself and daughter, then you would have your own HSA. You still would be under that max contribution limit for 2021 of $7,200.
Okay.
But you could divide it any way you want to between the two HSAs.
Okay, thank you. That's a great answer. Because that was something I wasn't sure of and couldn't really figure it out. Does anybody else, do you have any other questions? Say free, you should be able, oh, perfect.
I don't have a question, but I cannot stress enough HSAs. When I sit down with folks that are retiring from the companies that I work on their retirement plans, they typically ask me, we'll sit down and they'll ask me, do I have enough money to retire? And the only number I know is how much money's in their 401k account. And so I normally answer their question with about 12 different questions as far as, do you have any debt? Do you own your own home? Are you putting kids through college? All that kind of stuff. But the number one factor in retiring is those healthcare costs. So by having an HSA, it even helps employees, helps yourself, whoever, get on that track for that retirement readiness. I cannot stress enough. And also the triple tax advantages. It goes in without you paying income tax on it. It grows without you paying capital gains or income tax on it while it's growing. And then when you pull it out, if you use it for health expenses, you do not pay income taxes. Lisa said it a couple of times, but it's true. That is the only vehicle that has three triple tax advantage benefits to it. So with Roth IRAs, whether they're inside of a 401k plan or outside, those only have two. The money that you put in, you pay income tax on, but it grows tax-free and it comes out tax-free. But HSAs are honestly the only thing that goes in tax-free and comes out tax-free at all times, as long as you're using it for the healthcare expenses.
We have any other questions today? We will be throwing this presentation on our YouTube channel, and I will send something out to the group to just let them know where they can access that once it is edited and put up there. I want to thank again Lisa and Jasen and apologize for our technical difficulties. The third time was not a charm, and I of course then had every issue all in once, but so maybe I'm done for the rest of these and we can just sail through them. Thanks for joining us today, and we want to thank Qualified Plan Advisors for sponsoring the Human Resources Roundtable. We will get information out for our meeting in October. Thank you.